All right, welcome to the last section here, which is a chapter 11.3 for depreciation methods. Okay, so today we're going to be learning straight line. So again, the 5 components are still going to be necessary for you to be able to compute depreciation. However, straight line, the difference between straight line, which is going to be the last method I'm going to teach you today. Straight line is in a sense where you are going to depreciate it at a constant rate. So in this case, we're going to take our asset, right? And we're going to depreciate it evenly and spread the cost evenly throughout its entire lifespan. Okay? So that means when we are going to depreciate it, we're depreciating it evenly, the same amount every single year. Okay? So that means this formula, so as I remember from yesterday, it's going to be a combination between the two that we just learned. So we learned units of production and double declining. The first 3 formulas is a combination between the two, right? So here, the depreciation basis, right, is your cost of the asset minus salvage value, which is from units of production, while your depreciation rate is 1 over the estimated useful life, which came from double declining. Except this time, instead of multiplying it by 2, you're only depreciating it once, okay? The depreciation expense is your basis times rate, okay? And the other 2 formulas are the same, right? You have your previous accumulated depreciation plus the current depreciation expense, and then you have your book value being your cost of the asset minus the accumulated depreciation, okay? So let's go ahead and take a look at an example. So right here we have a $15,000 machine, okay? Its salvage value is $2,500. Its estimated useful life is 5 years. Number of units that it could produce is 10,000, and the date that you place into service is January 1st. Okay? So, right, depreciation basis, which is your asset cost minus salvage value. So in this case, 15,000 minus 2,500, you're going to get 2,500. Okay? The depreciation rate is going to be 1 over the estimated useful life. Okay, so 1 divided by 5, because the estimated useful life is 5 years, you're going to get 20%. Okay? 0.2, 20%, whatever it is, right? And then you're going to go ahead and to solve for the depreciation expense, it's the basis times rate. So you take your 12,500 and you're going to multiply it by 20%. So therefore, you're going to get 2,500. Okay? Your accumulated depreciation, once again, is still 2,500 because you have no previous years accumulated depreciation. So it'd be 0 plus the current would give you 2,500. And of course, when you solve for the book value, you're going to take your 15,000, which is your asset cost, minus the accumulated depreciation of the 2,500 to get 12,500. Okay? So then let's go ahead and solve for the second year. Second year, right? Same thing. You're going to go ahead and do the same thing. So in this case, depreciation basis is going to be your asset cost minus salvage value. So in this case, 15,000 minus 2,500 gives you the same number of 2,500. Your rate is still going to be 1 over the estimated useful life, which is 1 divided by 5, gives you 20%. Then step 3, depreciation expense is going to be your rate times the basis. So you're going to take your 15,000, you're going to times it by 0.2, and you're going to get the same amount of 2,500. Now, once you've done that, then the accumulated depreciation, you add those two numbers together, right? You get your current of 2,500 plus your previous, which is 2,500. you get 5,000, right? And then your book value becomes 10,000. So what you're going to notice is, okay, hey, my numbers came out almost the same, okay? And then you're going to do the depreciation for the next year, which is going to be the same thing. And then it's going to be the same thing, and the same thing, and the same thing. Now check this out. When we're thinking about the basis and the rate, you're going to notice this. It's going to stay the same. So the purpose of straight line, right? We said we're going to take the asset cost, or in this case, the basis, and we're going to spread it evenly across the life of the asset. This is it right here. So we're constantly going to depreciate it at the same amount every single time. So in this case, this is one of the easier depreciations, is because once you solve for one, boom, you're pretty much done for the rest of this life, because it's going to be constantly depreciating it by the same amount every single time. Okay, so you're going to have the depreciation, basis, rate, and the expense to be the same. Okay. And of course, so the only thing that we're looking here is that you're going to be at the end of the 5th year, the accumulated depreciation should match its basis. And once again, the end of the 5th year, your book value should still equal your salvage value. Cannot fall below, cannot fall. In this case, you can go above, but you cannot fall below. Okay. So once again, once you solve for one, you pretty much are set. You don't need to solve for any more. Okay. But that's only true if you start from January and you are depreciating it for a whole year. However, we'll talk about partial years in a few seconds. Okay. So how do I journalize this? Well, same thing, right? It's the same exact journal entry where we do depreciation expense and accumulated depreciation. So remember, throughout all 3 methods, the journal will stay the same. The only difference is the number that you calculate. So in this case, right, we said that on the first year, it was for $2,500, okay? So then how would I depreciate my, for the second year? It will be the same exact journal entry, obviously different year, because you're going to depreciate it for the same exact amount. So what you're going to notice is that you will be having the same exact journal entry every single year. Okay? Easy. So you don't have to do too much calculations here. You're just figuring out one number and then basically solving from there. So this is easy, easy, easy. And this is why it's most common that a lot of people use this, because instead of having to figure one number per year, right? If they could just figure to spread out the cost evenly amongst the useful life, and getting the same rate, the constant rate or expense to be the same number every single year, it just makes it that much more easier to remember and to journalize, because it's going to be the same amount every year. Okay. Okay. Any questions there? No questions? Okay. So then what happens when we have an asset that's placed into service randomly in the year? We call this partial years, right? So for this example, when I purchase a machine, all right, for $10,000 with a salvage value of $2,500, the estimated useful life is 5 years, and it can produce up to 25,000 items. And the date that we placed into service was October 18. Okay? So in this case, the assumption is that if we are planning to depreciate it, right, and we are planning to adjust at the end of the year, right, October 18, which is less than half the month, you're not going to depreciate for the month of October because it's less than 50%, right? It falls after the 15. So therefore, I'm going to start depreciating it for the month of November and then for the month of December. And that's where we have to treat our asset for that very first year only for 2 months. So that's why we need to calculate this once again. Since my asset is only 2 months old, right, we must adjust our expense accordingly. So starting with the first year, depreciation basis, which is your asset cost minus salvage value. So you're going to take your 10,000 minus 2,500, and you're going to get 7,500, right? Then you're going to take your depreciation basis, which is 1 over its estimated useful life, which gives you 20%. And when you multiply across, right, you're going to get 1,500. Now, in this case, this is for one whole entire year, right? Because 20% of this is for the whole entire year. But because we placed it to service as of October 18, which we can't even count it for October, we must measure it in terms of years. So in this case, we're only going to start depreciating it for November and December, which means that it's only 2 months old. So in this case, we need to adjust this number because my asset I'm not going to depreciate my whole asset for one whole year. I'm going to adjust it accordingly to make it match for its age. Okay, so in this case, I'm going to take my 1,500 and I'm going to figure out how much the asset is actually for the first year. So in this case, it's going to be 2 divided by 12, right? Which is 0.166667, or it's also known as 1/6, all right? Or you could just multiply 2 and divide the whole thing by 12. You'll still get the same answer. So in this case, when you multiply it by the 1,500, right, you're going to get $250. And that's how much you should depreciate because it's only 2 months old. You don't want to waste 10 months of your fixed asset when you haven't even used it for those 10 months. Okay? So in this case, we're going to adjust this amount by $250, which is for 2 months out of the 12 years. 12 months. Okay? And then you're going to journalize it the same exact way, 250. Okay? But of course, that means every year after that, it's going to be constant at 1,500. Okay, so in that case, it's just only this part that you just have to be very careful in the very beginning is when did you actually place into service, because you don't want to accidentally depreciate for the whole year. Okay. All right, so that was chapter 11.3. Now I'm going to be introducing you to concept for chapter 11.4, which is called amortization. What is amortization? Well, if you remember, amortization, right, is another word that we use to describe another way to depreciate. But in this case, right, if depreciation is to fixed tangible assets, amortization is the same thing, except we use amortization to depreciate intangible assets. Okay? So again, depreciation is to tangible assets, amortization is to intangible assets. Just like land, is to deplete. Depletion is to land. Okay? All three words are more or less the same idea, same concept, because what it does is it takes the value of that asset and it loses its value, right? You're adjusting the value of those assets. The only difference is what kind of asset they are. So again, depreciation is to fixed tangible assets. Your amortization is to intangible assets, so other assets. Okay, and then depletion is for land, but we're not going to talk about depletion today. Depletion is, once again, something that you learn in more intermediate levels of accounting. Okay, so in this case, amortization is another fancy word for depreciating intangible assets. Now, in this case, when we talk about intangible assets, what are those? Those are going to be your patents, your copyrights, your license, your trademarks. So again, intangible assets are things that you own, you have ownership over, but it has no physical, tangible characteristic about it. So in this case, can you touch a copyright? You can touch the paperwork for it, but you can't touch what it actually represents. It's like an invisible field around an idea, right? That's what you're protecting. You're protecting property. You're protecting a song, right? You're protecting movies, right? Same thing with licenses. If you allow someone to be able to reproduce something that you yourself make yourself, you are allowing somebody to have a license. But this is legal property. Can you physically touch legal property? No. Can you touch the invisible protection over a patent? No. You guys get the point. So in this case, that's what makes this unique. So intangibles are so basically intangibles are your other assets that you can't physically touch. Those are what you're going to amortize. Now, if you guys actually know things about patents, copyrights, and licenses, right? They expire. That means they hold no salvage value because they expire after a certain given point in time. Now, for this class, it's very hard to determine patents, especially you don't know for intangible assets, it's very difficult to determine what kind of lifespan they would have. Okay, for a small idea, right? A small patent idea could be their lifespan could be 5 years. Things like Starbucks, when you license out Starbucks, that could be a 10-year contract. Disney, their copyrights go for 25 years, even 50 years. Nobody can touch their property because it's Disney, right? They've been doing this for X amount of years. So their lifespan could be 50 years for copyrights. Okay? So think of that. If there's too many variations between them, what I want you to do is, in this class, I'm just going to give you a straight number. It's going to be 15. Okay? We're going to assume that intangible assets will have a similar lifespan that's up to 15 years. But at the end of the day, at the end of its life, it expires, and that's why you have to renew your patents, license, copyright. So that means you have to give it value. You have to renew it. So that means you're going to have to repurchase it for the value it actually holds. Okay? And yep. And so here's one concept. Since we just learned exactly what we learned earlier, which was straight line, right? You treat amortization identical to straight line. Okay, so that means you're literally going to spread the cost evenly amongst its entire life. Okay, cost of, yeah. Okay. So, but the only difference is instead of saying depreciation, it's going to be amortization basis. Now, because it's similar to straight line, right? The basis is going to be the asset cost minus salvage value. But for amortization, there is no salvage value. So your assumption here is it's just the asset cost. Okay? The amortization rate is 1 over its estimated useful life. Then the expense is going to be basis times rate. Accumulated amortization is the same thing. Previous amortization plus current year's amortization expense. And then book value is going to be your asset cost minus accumulated amortization. Okay? Same exact thing, except instead of using depreciation, you're using amortization, and it follows through exactly like straight line. So that's why I put these two concepts together, because when you know one of them, this one is exactly identical to that one. Okay? So here's an example here where you bought a patent. Okay, it cost you $20,000. The estimated useful life was 15 years, and the date that you placed into service is January 5th. Okay, so in this case, January 5th. If we are amortizing it at the end of December 31st, then the assumption here is you're going to amortize it for the first year. You're going to amortize it for a whole entire year. Okay. So amortization basis, once again, is your asset cost. So in this case, $20,000. Okay. Your amortization rate is 1 over the estimated useful life of 15. So 1 divided by 15 gives you 0.0666667. Okay. Your depreciation expense, amortization expense, is going to be your basis times rate, which in this case gives you 133.33. Okay? And your accumulated is 133.33 because there's no previous. So your book value is going to be adjusted. So you're going to take your 20,000 minus your 1,033.33 to get your 1866.667. Okay? And as I've mentioned before, right, since straight line and amortization are similar, you're going to get the same exact numbers too. So you're going to get the same basis, you're going to get the same rate, and you're going to get the same exact expense. So in this case, another 133.33. And then you're just going to add those two values together to get your accumulated, which you're going to subtract out from your asset cost to get your book value. Okay? Straightforward. Right? And how do I journalize this? Same exact way you would journalize your depreciation. Only difference is you can't use the word depreciation. So, in this case, easy concept once again. Instead, you're going to use amortization expense and accumulated amortization. Okay? Straightforward. Any questions? So chapter review. Okay? We talked about straight line, right? Where it's a combination between units of production and double declining, right? The formulas are a combination. And we said that you use straight line if you want to spread the cost evenly amongst the estimated useful life, okay? Where we talked about amortization, which is when you depreciate intangible assets, okay, follows the same exact rules as straight line. Only difference is you don't have a salvage value. That's the only difference. Okay? And there's the formulas there. Okay? So let's go ahead and dive right into the exercises. Okay? So we have questions 1 through 3 here. Okay? So here is question number 1. Okay? You purchase a coffee maker for $250 with no salvage value. Okay? The useful life is 5 years, and it can produce up to 25,000 pots. Okay? And of course, you place this coffee maker into service on January 12th. Okay? So what did we buy?
Coffee maker.
Okay, good. How much is my coffee maker? What's the cost of it?
Maker for $250.
Good. Okay.
With no salvage.
With no salvage. Good.
January 12th for 5 years.
Good. January 12th for 5 years. Okay. Now, question to you. What does January 12th tell you?
0.
What do you mean by 0?
We don't have what is called as 0, the salvage.
I'm talking about the date that you placed into service. So January 12th. What does that tell you? Are you going to depreciate starting January, or are you going to depreciate the following month?
Starting January.
Starting January, because it's the 12th, which is 50% of the month. So in this case, you are going to be depreciating starting January. Okay? So in this case, what is my depreciation basis?
Depreciation. The first thing we do is cost of asset minus salvage.
Good. So in this case, what do I get?
We got same number because we have 0.
Good. So in this case, 250. All right. So what's my rate going to be?
Yeah, the rate 1 up to estimate useful life.
Good.
Useful life. And after this, we do depreciation expenses.
Well, first, what's the rate?
Okay, the rate is gonna be 1 up to 1 second, because I use my phone to attend the class. So I can't calculate it because if I go outside, but we're gonna do 1 up to useful life, like 5 years, right?
Yes.
Yeah, I can't do it in my phone because I don't have calculator.
Stacy, can you help her out?
We do just 1 up to 5.
1 divided by 5, yes. 20%. Okay. So then, what's my depreciation expense?
Expense equal depreciation basis by rate.
Okay.
Basic, yeah. previous year, 12. Stacy, did you get it? Because I can't use my calculator.
It's 50.
Okay, $50. Okay, good. So then what's my accumulated depreciation?
Previous year,
Okay. Do you have a previous year?
previous year, we have just January 12. We don't have the previous year.
Okay. Plus what?
Plus the 5 years, right?
No. Accumulated depreciation is your previous year's accumulated depreciation plus your current year's depreciation expense.
Oh, okay. It's gonna be like 50.
It's just going to be 50. Good. So then what's your book value?
Yeah, so this is I decided. Could you show me, please, the book value? Book value is cost of asset minus. It's cost of asset minus accumulated depreciation.
Okay. So what's my asset cost?
Okay. Cost of the asset. What is it? Cost of asset. Like we got the 50.
That is your depreciation.
Mm-hmm.
What's the cost of my asset? What did I buy it for?
Yeah, 2,500.
$250
Mm-hmm.
minus accumulated depreciation.
Mm-hmm.
What is in your accumulated depreciation right now?
It's gonna be 200.
Okay.
Because 250
Yes.
minus 50.
Okay, good. Okay. So then let's go ahead and solve for the rest. Okay. So year 2, what's my depreciation basis?
It's gonna be 250.
It's going to be 250.
And with 0.20, the rate.
So then what's
50.
another 50?
Mm-hmm. And here accumulate it's have it. Okay. Previous year minus.
Not minus, plus.
Plus, sorry. Oh, we're gonna be got 50 as well.
Okay, so 50 plus 50.
100.
Good. So then what's your book value?
Okay. book value cost of asset minus accumulate. It's gonna be 200 minus 100, correct?
No, no, no. Not book value. Your asset cost is 250.
Okay, 2 and 250 minus 100.
Okay, and what do you get?
I got 150.
Okay, good. So then what's the what's the next one? What is the basis for third year?
We're gonna be got 250
So
with 20%.
okay, so in this case,
And
you notice that
everything same.
everything's the same.
Mm-hmm.
Okay, including the depreciation
50.
expense. So then my accumulated depreciation for the third year, what is it?
Okay. Now, 50 with 100 and 150.
Okay, and your book value?
Okay, we have 250 minus 150, 100.
Okay. What about my accumulated depreciation for year 4?
Okay, now it's 50 with 100 and 150 is gonna be 2. Uh, 200 and now it's 50. We have 50.
Okay, and last one?
It's 250 with 0.
Good. So in this case, my salvage value is 0.
It's matching. Yeah.
Yes. Okay, it matches. Good. All right. So let's go ahead and journalize the entry for the first year. So in this case, how do I journalize this?
Depreciation, right?
Mm-hmm.
Okay.
Okay, and what's my credit
250.
account?
250.
It's not 250. What's your depreciation expense for the first year? How much did you depreciate for the first year?
Okay, 1 second. Like book value we take or
No,
expense?
we're looking at depreciation expense for the first
Okay,
year.
50. 50.
It's 50. Good. Okay. But what is going to be my credit account?
50.
Yes, but what's my credit account?
50 with the 50, like 100?
No, I'm not talking about my debit or credit. I'm talking about the account. What would it be? If I have a depreciation expense, where does my even credit go?
Uh, how do you say it? Is it receivable?
This is depreciation. It has nothing to do with the customers.
Okay. Depreciation. Oh, accumulate.
Accumulated depreciation. For $50. Okay. What about for journalizing it for the second year? What was my depreciation expense for the second year?
It's 50.
Is
With a
this?
50.
It's going to be the same exact one.
Okay.
Okay.
depreciation expenses and return for depreciation. Okay.
For $50, yes, for the second year.
Okay.
Okay, good.
And if we have the question like ask us do we do like debit or credit, it's gonna be this is credit, right?
What?
Is it asking us if this one is debit or credit?
For the journal?
Mm-hmm.
Yes, you would debit your expense
Mm-hmm.
and you would credit your accumulated.
Okay.
Will I ask you to journalize it? Yes, but I'm also gonna. But what actually in this case for the exam, I'm just gonna ask you what was the depreciation expense for year one, what was the book value for year one, things like that.
Oh, good.
Okay.
Because I'm just confused between the credit and debit when it's coming to us. Is it we debit it or credit it?
Well, expenses. How do you increase expenses?
Increase expenses, credit.
No, expenses.
Expenses, we spend money.
We spend money, but that's exactly where you need to understand. You're thinking about spending money. Expenses, yes, you bought something, right? But
Mm-hmm.
if you're thinking spending cash, you're thinking about decreasing your assets. So no, you don't credit expenses. You increase them with a debit.
When we spend money.
When you
When we
spend
spend.
money, if you think about spending the actual physical cash,
Mm-hmm.
then you're thinking about an asset. To decrease an asset, yes, you credit it.
Okay.
But expenses are things that you buy for operating the business, right?
Mm-hmm.
Accumulated depreciation is a contra account. Okay? A contra account will always flow in the opposite direction as the main account or the sub account, whichever one it is, right? In this case, this accumulated depreciation will go under whichever fixed asset that you're actually depreciating. Okay? And fixed assets are gonna always be debited because they're assets, right? So in this case, since it's a contra account, it's always going to be credited. Right? So question number 4. We have here that you purchased a couch, okay, for $2,485, which includes all the fees, okay, with a salvage value of $150. Okay, its estimated useful life is 7 years, and you put this couch into service on August 25th. Okay, assume that the adjustments are done at the end of every month. Okay, so there's your key word here, at the end of every month. Okay, so what did you buy? We bought a couch. How
Couch.
much was that couch?
2,485.
What's
Cost is
my
for
salvage value?
150. It's useful for 7 years.
And what did you place into service?
August 25.
Okay, so what does that tell you? Are you going to depreciate for the month of August, or are you going to depreciate the next month?
Next month
Next
because
month.
already done
Yes.
50%.
Good. All right. So let's talk about this. Now, remember, we're not depreciating it at the end of the year. We're depreciating it every single month. So, what's my depreciation basis going to be?
Okay. Depreciation. Cost of asset minus salvage.
Okay. $2,485 minus 150.
Yeah. 155. Okay, I have this.
You definitely can calculate this on a piece of paper.
Yeah, that's 2, 4, 8, 5, 0, 0, minus 100, 150. I got 24, 8, 3, 50.
150 is not $1.50. It's 150. Do it again. So 24.85 minus 150.
Okay. Do you know how do I use this one? Okay, thank you. I got 233,500.
Good. All right.
So for the next one,
What's the rate?
it's gonna be same. Oh, the rate it's 1 divide by estimate useful 5 0.2.
Not 0.2. What's the estimated useful life?
12, oh, 7, sorry, the 5. 1, 7. I got 14, 2, 8, 5, 7, 1, 4, 2, 9.
Okay. All right. So then what is going to be my depreciation expense for the first month?
Okay. Expense equal depreciation base. So 2, how do we calculate this one? 2, 3, 3, 5, 0, 0 equal.
Times. You're multiplying these two numbers together.
Okay. 0.14 to 8, 5, 1, 7, 1, 4. Oh, I got the 3, 3, 3, 5, 7.
In this case, this is for the whole year. Can you depreciate $333 on your asset for the whole year?
Sorry?
This amount is for the whole year.
Uh-huh.
Can you depreciate it for All of this for one whole year?
Yes, because we got like same, right? All the
Well,
time.
yes, but in this case, right, you put your asset into service as of August 25th.
Mm-hmm.
Can you depreciate your asset for a whole year?
We need to do it for every month.
Right. Okay, good.
Mm-hmm.
So this is for a whole year.
Okay, we need to do it for whole every month.
Right.
Mm-hmm.
So how are you going to figure that out?
Uh, we got August. What we have for the rest of the like how many months we have, right?
Well, okay, so in this case, by depreciation expense, that's for the whole year. 333.57 is for the whole year.
Mm-hmm.
I need to only depreciate for the month.
2780
Good. What did you do?
divided by 12.
You need to divide this entire amount by 12 because I'm not depreciating at the end of the year. I'm depreciating it at the end of the month. So this case, I'm going to take my 333.57 and I'm going to divide it by 12 because I'm depreciating it every single month.
So, but we don't have whole the year because we start from August.
Okay,
How many months left, right?
yes, but the
Why 12?
question was asking you to depreciate for every single month, not at the end of the year.
I'm not sure. Like I thought, because we start in August. How do we like do it for whole the year and we have just 4 years, 4 months left?
Well, so if you're gonna be doing it that way, right? So then think about it. If for one whole year is $333.57, can you depreciate for one whole year? No, you can't because you treat your assets like they're your kids, right? They have age. In this case, you can't depreciate for one whole year because it's only 4 months old, right? If it's only 4 months old, then out of that $333, how much of it can you depreciate? If that's one whole year.
So if they ask us for 1 year, we need to divide by 12. Even like we start from like end of the year.
No. If it
Okay.
asks you at the end of the year, you do not divide by 12.
Oh, okay.
I'm only telling you because this one is not asking you at the end of the year. It's asking you to depreciate it for that month.
Okay.
I'm only asking you to depreciate for September right now. How much is it going to cost me to depreciate for just September? For the very, very,
September.
very first month. Just 1 month.
Um, I will do it for just 1 month.
Just 1 month.
So we divide by 1 month
You
by
did
like
well.
end
How
of
many months are in 1 year?
12.
12. And if you had $333 for the whole year, how
Mm-hmm.
much of it is for 1 month?
We need to divide it by 12.
Correct.
Mm-hmm. Okay. So if they ask us end of the year, how do we divide it?
If it asks you for the end of the year, how old is your asset?
Okay. If it's like 3 months.
Then you do 3 divided by 12, right? Because that's
Divide
3
by.
months out of a whole year, right?
Oh, okay. Like all the time we need to divide by 12 because it's year.
No. In this case, I'm looking at months. I'm depreciating it at the end of the month. So right now I'm on September. How much are you going to depreciate this asset for?
Yes.
So in this case, this is how much I'm going to depreciate for just 1 month. Okay? So in this case, what's my accumulated depreciation? It's going to be previous year. You don't have a previous year or a previous month. Okay? So you're going to add your depreciation expense for that first month. So what is going to be my book value?
If it's like for the whole year, we divide by 12.
No, if it's for the whole year, you need to figure out how old your asset is and then figure it out, because you're in this case, if you are dividing by 12, you're figuring out how much you're going to depreciate for the month.
I need to go and review it again because I'm just confused.
I'm not asking you to do it for the end of the year. I'm asking you to do it for the month.
Oh, for the month? Like 30 days or 1 month?
1 month.
Oh, we need to know how many months we have.
I'm asking you to just depreciate for the first month.
Just 1 month, right?
Just 1 month.
Okay, by one.
Okay, 333 is 1 whole year. How many months are in a year?
12.
If I only want 1 month, then what do I do?
We divide by 12.
Yes.
Okay. So you want me to do it?
Say that again?
Do you want me to do it now?
Well, Stacy, you already
So
figured it out.
Okay.
So 333.57 divided by 12, what do you get?
2.
333.57 divided by 12, what do you get?
333, 27,
57.
57, divide by 12. I got 27, 79.75.
Oh, what does that tell you? That tells you to round up, right? So 2780.
Yeah.
Okay, so that's just for 1 month.
Okay.
Okay, so now let's move.
It's gonna be like all months the same, right? Because this is for each month.
Correct. In this case, I'm only depreciating it by the month. But okay, so now what is my book value?
Where's my book value? Okay, book value. Book value it's cost of asset minus accumulate.
Okay.
We got cost. It's cost us what? How much it was? Okay, 2,4,8,500 minus 27. 27. Okay. 2, 4, 8, 5, 0, minus 27. I got 24, 8, 4, 7, 2.
2457. and 27.
I got 2 8 2 4 8 4 7 2.
2485. How do you get 2485 minus 27? How do you still get 2484? It's not $2.78. It's $27.80.
It's with me 2 4 8 4 7 2.
Look at how much money you have. If you have $2,485 and you minus $27, how in the world do you only get $2 off? How can it still be $84 if you subtracted $27?
27.80. I'm not sure. Give me 10. 2 2 8 5 0 0.
You're using the wrong number too. You said it's 2485. Why are you using 2030? It doesn't. It still wouldn't even add up. So 2,485.
Oh no, I got same number yours. 2457.2. Okay.
Okay, so then how do I do the next one for the next month? What's my depreciation basis?
It's gonna be same.
It's going to be same.
And the rate is same.
And the rate's going to be the same.
And the expense is same. So now,
What's my accumulated depreciation for the second month?
okay, we're gonna do a 27 with a 27, correct?
Okay.
27, we got 54.
55. You forgot the 80 cents.
Oh yeah. Now this one, how do we got the books? It's cost minus. Okay. Now we have this 2 4 8 5.00 minus 55.
60.
60. We got 29.4.
Good. Okay. Now what about the third one? For the third month. What's my accumulated depreciation now?
27 plus 50. Oh, 27 something. 27.80 plus 55.60. We got 83.4. It's minus 2, 5, and 0, 0 minus 85. 3.4. We got 2401.6. So now we add this all together. 27 27.6 with 18 plus 55 point 60 plus
Not 5560. We're on 8340.
5560, right?
We're on the fourth one, not the third one.
Oh, I thought we need to add them all together, the three of them, right?
No, it's only the previous year's
Mm-hmm.
depreciation, accumulated depreciation. So the previous year's only 83.
Okay. We do it with who?
What? Okay, so in this case, this already includes the 5560. So 8340,
Mm-hmm.
which is your previous year's
Mm-hmm.
accumulated depreciation plus your current year's depreciation expense.
So it's going to be 50 with the 83, correct?
Your previous years of accumulated depreciation is $83, right? What's your current depreciation expense?
It's 4, 850.
What is your current depreciation expense?
Expense. Oh, okay. 27.80.
Okay, there you go. You add those two numbers together. 8340 plus 2780.
111.20.
So, I thought we add all of them together, like the three of them.
No. No, you
Okay.
don't. You were doing so
Okay.
well, but I don't know where you went off the rails here because you did the second one correct and you did the third one correct. But why did you do the fourth one incorrect?
Because I thought we add all. Okay, now I understand. We do like the expense with uh, with the previous year. Now
Yes.
how much? Okay.
The
Mm,
book value is 2373.80.
so now we minus this from the actual number, like the 248. Okay.
Yes.
So
Okay.
now, yeah.
So what's the fifth month?
Now 111 point 20 minus
Not minus, you're adding.
oh, added 111 point 20 plus 27.80. 27.80. Okay, we got 139. Okay. Now we minus this, the 139 from the 2485. Correct?
Yes.
Okay. 2.2825.00 minus 139. We got 11.415.
No.
2346.
So do it again. 2,485.
85.00 minus 139. 2346. Okay.
Okay. So I'm gonna fast forward because it's just the same calculations over and over again. So in this case, you should get the next one is 166.80, and then the next one is 194.60. Okay. And if I pull these down, then I get 2,318.20 and 2,290.40. Okay. So that's that. So let's go ahead and take a look here. Number 5, record the adjustment entry for the month of August. Okay, for the first year. Okay, so in August, for the first year,
Depreciation.
let's look at this again for the month of August.
Yes, for my savings. Okay. You purchase.
When did you purchase this asset?
You purchased it August 25.
Okay, so what does that tell you? Are you going to depreciate August or are you going to depreciate the next month?
Oh, the next month.
Okay, so this question is asking what are you going to do when you need to depreciate for August? How are you going to journalize this?
Expenses. Purchase.
No, we're not purchasing anything. We're focusing on just depreciating. So in this case, is there going to be an adjustment entry that you need to journalize on August?
So I don't know.
No, because you don't depreciate until September.
Yeah.
So is there any reason that you need to journalize in August?
No. But we don't do anything to show like we start in August.
You just
put the time.
you just answered the question twice. I bought it in August 25th. When do I start depreciating this?
September.
September. So in August, is there any journal I need to write?
No.
No. So in this case, for this one, you could just write no entry because there's nothing you need to write in here. No entry. Right? So now question number 6 says, now record the adjustment for the month of September. Okay, so in September, what was my first month's depreciation expense?
September.
For September. $27.80, right? So September 30th, right? What should my journal be?
Depreciation. Expense.
Good.
And after there's how do I say it?
Accumulated depreciation.
Accumulated depreciation.
Okay? For $27.80 because that's what I have in my journals here. Okay? All right. Question number 7. So this is the question you were asking, Gerari. You were asking, what if I was asked that I was supposed to depreciate at the end of the first year, assuming that I adjust my books December 31st?
Yeah.
Okay? So if I were to do this, instead of depreciating it every single month, what if I have to do it at the end of the year? How do I figure out this amount? Well, how old is your asset?
Yeah. We'll see how many months left.
Okay, how old is your asset?
Okay, what is it? We start from August, and we don't count August, September, November, like October, right?
Mm-hmm.
Okay. We have September, October, November, December, for 4 months.
4 months, right? Okay, so how do you figure this out? Well, if depreciation expense, right, was, what was it? So it's the 2033.85, okay, times the 0.14, right? We know you get $333.57. That's for one whole year, right? My asset is not 1 years old. It's only 4 out of 12 months. Okay? So that means if it's 4 added 12,
Can we also do 2780 times 4?
yes, she can do that as well. But in this case, I'm showing her how to do the partial years. Okay? So in this
Got
case,
3
what?
if we divide. We get to get to 3 if we divide by 12.
Yes, you could divide the whole thing by 3. And what do you get?
Okay, now we divide the 3.57 by 3, correct?
Yes.
Okay. 3.57 divide by 3, we get 111,090.
Okay? But in this case, this is what Stacy figured out. If it's 4 months old, right? You could just look at here in the chart. 4 months, right? My accumulated is still 111 and 20 cents. You get the similar same answer.
Oh, okay.
Okay? So in this case, that's exactly correct. If you were to depreciate it by December, by the end of the year, assuming that you do your adjustments at the end of the year, right? You will get 111 and 20 cents. Because that's the same thing, right? If your asset's only 4 months old, right? What will then calculate it? 1, 2, 3, 4 months, right? Of $27.80, you're going to get a total of $111.20. Same thing here as well. Okay. All right, so that's that. Let's go ahead and do the very last problem here, which is question number 8, 9, and 10. So here we're going to be looking at an amortization. Okay. So in this case, right, on January 12th, you decide to purchase a copyright for $2,500. Okay. Its useful life is 15 years. So what did I buy?
Purchase copyright for 2,500.
Okay.
15 years.
For 15 years. When did I place into service?
We don't have 0.
When did I place it
Jan-
into service?
January 12th. So we will be start from January because it's not 50%.
Correct. It's more than 50%. So in this case, right, I am going to amortize it at the end of the year. Okay? So in this case, right, depreciation basis.
January.
And we're starting from January. So what's my depreciation basis?
So basis cost of asset minus salvage. We don't have salvage. It's gonna be same.
Good.
The rate we got 1 up to estimate useful life, like 1 up to 5, 15. Sorry, 1. We got point 66666.
Okay, good. 0.0666667. Okay?
Yeah.
So what's my depreciation expense? Or in this case, amortization expense.
Yeah, equal basic with rate, by rate. So where is the basic? The basic is 2 2500.00, what we said, by, right, the right is 0.06666667. We got 166.66675.
Okay.
So we're gonna be having all the right same, basic same, and depreciation expenses same. Now the equipment, okay, what is it? It's previous year,
Do you have a previous year?
not yet.
Okay.
Okay, it's not 166. So for the first one, how do I get it? For the first one,
So you just answered there isn't any previous year. So if there's no previous years, that's just 0.
okay, 0,
Plus what?
plus we said plus the 1666.
All right. So what's 0 plus 1666?
It's 166.67.
Okay. So
So
then
now,
what's my book
yeah,
value?
we need to minus 166 from the 2500. Okay, 2500 and 00 minus 166.67 is give us 2333.33.
Okay.
So now, okay, previous year with 166, like 166.67, add 166.67, give us 333.34. We minus now 2500.00 minus 333, okay, point 34. Give us 2166.66. So yeah, now we got 333, 333.34. Okay, you can see 3 times 3.34, 166.67 give us 500 point, okay, now here we have 500.00 minus the 500.01 give us 1999.99.
Good. So in this case, if you just keep on going,
Uh-huh.
you'll get those answers. Okay.
Now I'm very comfortable.
Okay. All right. So here you go. Last 2 questions of the day. Number 9 says, journalize the adjustment entry for the first year, and then also do the adjustment entry for the second year. So in this case,
Okay, we purchase.
we're not purchasing. We're doing the adjustment entry.
So, we purchase. Okay.
Depreciation expense.
Not depreciation. We want a copyright.
Expenses.
It's a expense, but what kind of expense? What do we call it when we need to adjust the value of intangible assets?
Fixed asset.
What was it?
Fixed.
This is an intangible asset, not a fixed asset.
Oh, is it an intangible?
Amortization.
Yes. Amortization.
Good. And what do you have here?
Same.
Accumulated what?
Accumulated amortization.
Good. So remember, in this case, right, it follows the same rules as straight line depreciation, but because these are intangibles, right, we can't say we depreciate intangible assets. We must use the correct terminology, which is called amortization. So it's identical to depreciation, except the word is just different. That's all that this is. So instead of saying depreciation expense, you must change it to amortization expense. Okay? So what did you do for the first year? How much did you amortize for the first year?
First year expensive 166.67.
Good. And what about the second year?
Second year it was the same.
Good. All right. Any questions? Tomorrow we're going to practice all 4 methods. So 3 depreciations and 1 amortization. All right. And we're also going to cover 11.5 and 11.6. Okay. But again, 11.5 and 11.6, I'm not going to test you on it. It's just information you should know. Okay. But tomorrow is going to be